Joanne Bonnie-Gaba here from freedommompreneurbydesign.com, and this is my third video of the quick series of videos that I'm doing today about tax-free savings account. I will do more later, but today I really want to finish off with a quick excerpt from this amazing book. I included the link to get this book off of Amazon. It is an affiliate link, so if you do purchase through the link, I might be able to buy a coffee or not. Who knows? But I wanted to disclose that because I want to be upfront with you. Okay, really quickly, if you're new to my channel, I do videos to help you get started successfully and quickly here on YouTube. I do book reviews, I do mindset hacks, I do a lot of commentary on investing as well, and that's why I'm sharing about the magic of tax-free savings account. I hope that in me sharing my excitement and some really good information about tax-free savings account, that it incites you to take action so you can benefit from this amazing vehicle. So in this video, I'm going to read from Tax-Free Savings Account, A Guide to Tax-Free Savings Accounts and How They Can Make You Rich by Gordon Pape. I'm reading chapter 4, which I think he just nails it on the head in terms of the magic of tax-free savings accounts. So here we go. Quick now. What is often referred to as the eighth wonder of the world? Just one sec. I would like to hopefully share a screen with you, but I don't have a visual of the book. So anyway, okay. The answer is compound interest. It is a simple but powerful way to get rich, provided you have the time and a little bit of self-discipline. Before I go any further, let me clarify an important point. Although the term generally used is compound interest, what we really are talking about is compounded profits from investment income of any kind. That could include dividends, rental income, capital gains, and anything else you earn from your invested money. So, for the purposes of this discussion, I'll use the all-encompassing term of compound income. Compound income simply amounts to profit earning more profit. If you invest $1 at 4%, after 1 year, you'll have $1.04. Now, you'll start to earn income on that extra 4 cents as well as your original dollar. It doesn't happen quickly, but over the years, that can add up to a lot of money. The rule of 72 is a classic way to calculate how long it will take for any amount of money to double in value through compounding. To use it, simply divide the return on the invested money by 72. For instance, if you invest $1,000 at an annual rate of return of 4%, it will take 18 years for your money to double, 72 divided by 4. But if your money earns 6%, it will double in 12 years. That's 6 years off. Of course, this assumes that you get to keep all the investment income for yourself. In reality, the government keeps dipping its sticky fingers into your profit. And that's been the big problem for Canadians until now. We've had no way to fully benefit from the magic of compound income in this country because Ottawa and the provinces are always taking a share of the pie. You may ask, what about RRSPs? Well, it's true that any investment income that is earned in a retirement savings plan is tax sheltered. You're hit with a big tax bite when you take the money out. For example, suppose you contribute $1,000 a year to an RRSP over 30 years and invest the money in guaranteed investment certificates that pay an average annual return of 5%. At the end of that time, the plan is valued at $69,761. Subtracting your $30,000 in contributions, you have earned investment income totaling almost $40,000. But as soon as you start taking money out of that RSP, the government swoops in and taxes it. If you are in the 30% bracket, you will give back $12,000 of the income you've earned over all those years to the tax folks. And you get to keep only $28,000 for yourself. The 5% you thought you earned ended up only being about 4% in after-tax terms. If you are in a 40% bracket, your after-tax profit drops to $24,000. Suddenly, compounding doesn't seem quite so magical anymore. Tax-free savings accounts change everything. For the first time, we have access to an investment vehicle that allows us to obtain the full benefit of compounding. The income we earn in a tax-free savings account is 100% ours to keep. No tax of it is taxed away. Sorry, no part of it is taxed away. Here's a table that illustrates what this means in terms of wealth building over time and shows the value of the tax-free savings account at the end of various time frames. I've assumed an average annual compound rate of return of 5% in all cases. Hopefully I can show this to you and you can see it. In case you're wondering, it would take 50 years for the value of the plan to surpass $1 million based on an annual contribution of $5,000. But with life expectancy increasing, readers who are 25 today have a realistic hope of achieving that $1 million. Also, remember that couples can save twice as much. We'll examine the implications of that in Chapter 12. Take a close look at the numbers in this table. There are two key points to take away. Start young. Compounding is like a rolling snowball. It takes time to gather speed and mass. And the more years the plan has to grow, the more impressive the returns will be. Look at the 1,000 line in the table. After 1 decade, the plan has only added $3,207 to your original $10,000 in contributions. But after 20 years, the investment income earned within the plan has ballooned to $14,719. That is $34,719 minus your $20,000 in contribution. After 40 years, the magic of compounding has given you a total tax-free profit of $86,840. So the sooner you begin, the more effective a tax-free savings can work for you. Obviously, none of us can turn back time, but however old you are today, the same basic rule applies. The sooner you begin, the more effective a tax-free savings account is. Contribute as much as you can. Slide your eyes down each column. You'll see the more money you contribute annually, the more profitable a tax-free savings account becomes over the years. If you double the annual contribution from $1,000 to $2,000, your profit from compounding also doubles after the first decade, from $3,207 to $6,414. If you are able to contribute the initial maximum amount of $5,000 annually, your 10-year profit increases to $16,034. Of course, these figures assume no withdrawals are made along the way. The powerhouse effect of combining high contributions with many years of growth is apparent in the cell on the bottom right of the table. This shows you how much money is in a plan after 40 years of growth at 5% with an annual contribution of $5,000. The total is $634,199, which means your tax-free profit after deducting all contributions is $434,199. That's a nice nest egg to draw on our retirement. Let me show you that table again. Let me show you that table again. An extra point of return. Now, let's play with these numbers a little. The next table shows you the value of a tax-free savings account if you are able to add 1 percentage point of annual return over the years, moving from 5% to 6%. What a difference a percentage point makes over time. After a decade, the extra return doesn't translate into a large profit gain. At $1,000 annual contribution level, the additional growth is only $765. which suggests that for older people, the added risk involved may not be worth it. But look what happens as the year passes and the magic of compounding takes hold. Staying with the 1,000 contributor, at the end of the second decade, the additional gain is 4,274. After 40 years, this person is ahead by $37,208, because he or she invested the money wisely and earned 1 percentage point more. Here again, the more you contribute, the greater the impact of the extra percentage point of return. An annual contribution of $5,000 that is invested to earn an average annual gain of 5% grows to $634,199 after 40 years. But at 6%, it's worth $820,238 at that stage. The extra percentage point has given you an additional $186,039 to help fund your retirement. Now that's impressive. End of year contributions. Finally, let's look at one more set of numbers. The tables we've looked at so far assume the tax-free savings contributions are made at the start of each calendar year on January 1st. Most people, however, tend to put things off. So let's see what happens if the contributions are delayed to the last minute, to December 31st of the same year. Here's what our 6% table would look like in those circumstances. This may be difficult to believe, but waiting until the end of each year to make a tax-free savings contribution can end up costing you tens of thousands of dollars in lost profits. The same applies to your RSP, by the way. Again, you don't notice much of an impact in the early years, but as the compounding snowball begins to gain momentum, the price of delaying starts to add up. The person who contributes $3,000 annually on December 31st of each year has $6,621 less profit after 20 years than someone who makes the same contribution 12 months earlier on January 1st. As we move out to 40 years, the impact of delaying a contribution really hits hard. Someone who puts $5,000 a year into a tax-free savings account on January 1 of each year, over that time, will have a plan worth $820,238. The person who waits until year end will have only $773,804. That's a difference of more than $46,000, proving once again that procrastination can be expensive. Action summary. Start immediately. Set up a TFSA as soon as you can. The more years your money can grow tax shelter, the wealthier you will be. Contribute, number 2, contribute as much as possible. Any amount is better than nothing, but if you stretch a little bit, the reward at the end will be much greater. Number 3, contribute early. Don't wait until New Year's Eve to make your annual contribution. Get the money into the plan as early in the year as possible. And number 4, within reason, aim for a higher return. Don't take needless risk with your tax-free savings money, but don't be overly conservative either, especially if you are under 50. An extra percentage point of profit will add thousands of dollars to your wealth over the years. Did you see it? Did you hear it? Did you get it? The magic of tax-free savings accounts. Joanne Bonigaba here. Remember, as always, quality versus quantity, and I'll see you in my next videos.